This video is brought to you by Ground News. At first glance, Australia's economy looks like it's doing pretty well. Australia's GDP has been growing pretty steadily since late 2020, and the fact that Australians just re-elected the incumbent Labour government with an increased majority would imply that they're doing something right. However, peek under the proverbial bonnet and things aren't so rosy. The economy is being kept afloat by immigration and government spending. Disposable incomes have cratered, and earlier this year, one of the big credit rating agencies warned it was considering downgrading Australia for the first time since 2003. So in this video, we're going to take a look at what's gone wrong for the lucky country, and how it might be fixed. If you're interested in the political alliances and groupings which shape our world, then you might enjoy our poster, Every Alliance Explained. It shows, in slightly confusing detail, all of the world's major alliances and how different countries link together. Check out the poster by clicking the link in the description. So let's start with a bit of context, because Australia's recent economic history is pretty astonishing. As you might already know, Australia's GDP grew every quarter from 1991 until the pandemic in 2020, the longest consecutive streak in world history. This was in large part because Australia's economy had two things that rarely come together: an abundance of natural resources and a strong domestic economy. When it comes to natural resources, Australia has vast deposits of metals and hydrocarbons, including iron, coal, oil, gold and lithium, which it exports around the world, especially to booming economies in Asia like China. If you just looked at Australia's export profile, you'd probably assume it was a low or middle income country, with an underdeveloped economy dependent on commodity exports. But that's not the case at all. Australia also has a strong domestic economy, with one of the highest GDP per capita in the world, the second highest median wealth in the world, and a well-developed service-based economy, including world-beating education, technology and financial sectors. This duality has allowed Australia to weather almost every financial storm. Its strong domestic economy, for instance, helped it weather the Asian financial crisis in the late 90s, which crippled its largest trading partner, Japan, and a commodity boom driven by Chinese demand allowed Australia to sail through 2008. Australia did slip into its first recession in 30 years after the pandemic, but there was hope that this duality would save it again. After all, while Australia did see a spike in inflation post-pandemic, this inflation was fundamentally driven by an increase in energy prices, which was great news for Australian energy producers and provided the Australian state with a massive budget windfall. Since 2022, the Australian Treasury has revised its revenue forecast upward by over 350 billion Australian dollars, largely thanks to higher oil and gas revenues. Anyway, there was some hope that this surplus could be used to stimulate the economy back to growth, but this hasn't really happened. While aggregate GDP has been growing steadily since late 2020, save for the third quarter of 2021, this is mainly a consequence of large amounts of immigration, and GDP per capita actually fell for 6 consecutive quarters between Q2 of 2023 and Q3 of 2024. While GDP per capita did apparently grow by 0.1% in the last quarter of 2024, according to the latest data, this was largely driven by a rise in exports as a consequence of what's known as front-loading, i.e. American companies importing as much stuff from Australia as they could before Trump's tariffs came into force. On top of this, quite a lot of this has been driven by a marked increase in government spending, which has risen from 21% of GDP in 2015 to a high of 28% last year. Without this increase in government spending, the country would have fallen into recession last year. The government has even burnt through its windfall and now expects to run budget deficits for the foreseeable future. While there's no chance of an acute debt crisis, after all, Australia's debt-to-GDP ratio stands at just 50%, earlier this year, one of the big credit rating agencies, Standard & Poor's, said it was considering downgrading Australia's AAA credit rating, citing a lack of fiscal responsibility and unsustainable tax and spend promises made by both parties during the election campaign. So, what's gone wrong for the Australian economy? Well, as we see it, there are broadly 3 reasons: productivity, housing, and China. Let's start with productivity, which basically measures economic output per hour of work. In many ways, productivity is the most important metric in economies, because if your GDP is growing but your productivity isn't, then that just means that you've either got more people or you're working more hours. And, well, Australia's productivity has actually been falling since 2021 and is now back to where it was in 2016. This is the worst performance of any major developed economy and implies that Australians now have to work more hours just to maintain their standard of living. This is in part because of low-skilled immigration, which has brought average productivity down. But it's more fundamentally a consequence of Australia's low investment rate. In a sense, Australia has been resting on its proverbial laurels since the 2000s, when investment collapsed and hasn't recovered since. This created a short-term boom, as money that should have been invested was instead directed for consumption, but ultimately brought down productivity. The second reason is housing. As you might already know, Australia has one of the worst housing crises in the world. The ratio between the median house price and the median income has risen from about 3 in the 1990s to nearly 10 today, one of the highest in the world, and rising to over 10 in Sydney, Melbourne and Adelaide. Not only does this exacerbate Australia's productivity crisis by prohibiting people from moving to high productivity areas, it also squeezes living standards. This becomes glaringly apparent when you look at household disposable income, which basically measures household income after taxes and housing costs. As interest rates have risen, pushing up mortgage costs, disposable income have collapsed back down to 2018 levels, making Australia by far and away the worst performing member of the OECD on this metric over the past decade. Inordinate housing costs and massive mortgages have also left Australian households far more indebted than their international counterparts, which might explain why household consumption has tailed off in recent years. And the final reason is China. Much of Australia's recent growth has been driven by China's incessant demand for raw materials over the past couple of years, especially iron and coal. However, as the Chinese economy slows and moves away from primary industries like construction to more advanced industries like semiconductors, its demand for Australian commodity exports will wane, or at least flatline, thus undermining a key source of Australia's recent growth. And ultimately, it's this combination of weak export growth, stagnant productivity, and a political class that's been able to rely on occasional revenue windfalls to avoid much-needed structural reforms that present a challenge to Australia's long-term growth prospects. This is a complex and nuanced story though, and as such there's plenty more to read about this online, with 51 sources reporting on just the most recent round of fiscally questionable tax cuts. The issue is, how can you be sure that what you're reading isn't hugely biased? Well, that's a problem we face when making these videos too, and luckily that's where this week's sponsor Ground News comes in. For this story in particular, they've identified that there are at least 16 left-leaning and 11 right-leaning sources reporting on it. In fact, in addition to this, they've also shown the main differences in headlines among left-leaning and right-leaning outlets, with left-leaning outlets generally being more positive, presumably because it's a Labour policy, and right-leaning outlets generally being more critical, accusing Labour of essentially copying right-wing policies. We're able to do that because of our sponsor Ground News, whose incredible website and app lets you discover the news and pulls back the curtain on media bias. That's because every story comes with a quick visual breakdown of the political bias, factuality, and ownership of the source's reporting, all backed by ratings from 3 independent news monitoring organisations. But one of the best parts of the app is their blind spot feed. It presents you with stories and articles that haven't been reported on by one side of the aisle or the other, helping you better break out of your media bubble and discover what those on the other side of the political spectrum are really saying. This is all in addition to the biased distribution we mentioned earlier, and together these fantastic features help you to figure out exactly who's behind the stories you're reading and what agenda they may have. Ground News is such a useful tool for our current media landscape, and I think an app like this will only become more essential as the media landscape continues to evolve. If you're interested in everything that Ground News has to offer, you can get 40% off the Unlimited Access Vantage plan using the link in the description or by scanning the QR code. This offer is only available here, so make sure you go to ground.news/TLDR or click the link in the description to get started and support an independent news platform working to make the media landscape more transparent.